All right, we're back here. A little test number 2. The old reboot and restart sometimes does the trick. Blow on the cartridge. Thanks for joining Chicago Future of Finance. A little bit behind schedule. That's okay. We got a busy day. 45 minutes until the closing bell. The stocks are bouncing back. Pretty decent shape. Few important things I want to point out. Yesterday I dropped the green light on stocks and made it yellow, but not red, and that's important. And also Bitcoin's not red either. The risk radar is yellow for Bitcoin, for stocks. It's red for bonds. Obviously the important thing yesterday was yields breaking out to the upside. I wouldn't really expect bond yields to venture too far back down below 4.2%. The chart seems pretty clear when you have a lot of congestion at a single level like we did at 4.2%, and then it pops and breaks out. That usually means that maybe we go back to test 4.2 if bonds firm up further, but generally speaking, the cat's kind of out of the bag. Yields going higher doesn't have to be a problem. Yields going higher while the dollar is going lower is a problem. Today we've got the dollar firming up. Not too much, but still range bound, which is why I've got yellow on the dollar as well on the risk radar. And of course, gold still remains green, the strongest asset. Lots of momentum for gold and silver. So when stocks are down, gold was up, and now when stocks are up, gold is up. So that chart just looks incredible still. Let's cut straight to the chase and bring the guests in. We got a great show coming up here. I'm going to be joined by Noel Smith at Convex Asset Management. We've got Albrecht at Gamma Options Solutions. We're also going to be diving into ETFs with Wasif Latif, the LENS macro ETF that's been all over the gold and silver trade. So a lot to get through. Let's go to Mr. Noel Smith joining us from Sin City, Las Vegas. Noel, so market here seems to be firming up a little bit. Let's kind of start by painting the landscape for volatility. VIX down below 19, below 18, so a pretty decent retreat in volatility. What do you make of that?
It's kind of the opposite of everything that happened yesterday. So, we had, not only do we have an uptick in volatility, but the rate of change of that uptick was very notable. So everything that happened yesterday is kind of coming back in today. If you look at bond vol, kind of everything. It's like yesterday just standing on its own head.
The fact that we did get this big move in bond volatility and stocks kind of got shaken out, it was important to note that VIX had been creeping for the better part of 2 weeks. We talked about how some of the dispersion between equity-specific vol and index vol, it kind of looked like VIX needed to pop a little bit, did it not?
Yeah, especially with bond vol going up. I don't know if you noticed the MOVE index or the VXTLT. If you see that kind of movement in bonds, because bonds and stocks are usually cousins of each other, right? So it's very rare to have a large movement in one and not any kind of movement in the other. So we did expect, and this is kind of why when we talked last time, I talked about getting some long VIX upside call spreads. And we monetized a chunk of that yesterday, maybe a little bit early because we closed on the low. And then with this, Taco Tuesday, Trump reversing himself and saying that everything is cool with Greenland and we're not going to have this tariff war and we're going to kind of just settle things down. Everything is just basically inverting.
What's working? Silver and gold, generally pretty reliable. We also talked last week about maybe taking some hedges by looking at corporate bonds, HYG. That worked pretty well yesterday, but it's bouncing back pretty quick too. So tell me how you're thinking about that part of the trade, the credit side.
A hedging trade is not really meant to be super fast, something that you can just monetize instantly. You can do whatever you want, but that trade is there, because it's a cheap put spread is what we discussed. And that trade is there for more of a long-term, sustained, breakage of the theme in AI. And because it's a low dollar value bet, it's just not that big of a deal. Kind of like my silver puts that are going to go to money heaven pretty soon. They're March puts. They're so far out of the money now, and they're so low dollar value, I'm not going to sell them because that's kind of pointless. But, same general theme in HYG put spreads, you're talking about, a 20 cent wide put spread. It's just not a big deal. I do expect it to go to zero, but if it doesn't, it could easily, 7x, which is pretty good.
Yeah, okay. So you still have it there, in case of major reversal of trend. I think it is important, too, that while we got stocks buckling, that the stuff that was really trending the strongest didn't break. Look at, say, Micron, for example. Look at Intel. Obviously, gold and silver in the category of uptrends too. But the fact that you've got a few key semiconductor names that are rallying today as well, this is not chaos by any means. This doesn't look like the beginning of any trend in tech, at least, and that still seems like one of the most important trades out there.
Agreed. Yesterday was a difficult trade because it's kind of a head fake for me. So the rate of change in volatility and a lot of the vol metrics that we look at did kind of breach the threshold very barely of reducing risk. So we did kind of do that. And so I'm not enjoying this bounce back fully the way I would as if I did nothing. If I just didn't show up to work this week, I'm net lagging the market from that regard. But if we were down another 2% today, it would be a non-issue for me. So when vol moves that swiftly in that compressed period of time, it is kind of a problem with the book. And having everything reversed the next day is kind of maddening.
Yeah. The reversal, the back and forth, maybe it helps shake out some perhaps weak hands, as they say. I'm drawing a line right now on VIX here on my chart. And a lot of folks say you don't do technical analysis on VIX. Fine, screw them. I'll do what I want. Do what I want. And if I do that uptrending line, it kind of makes sense that, VIX would retreat, but could also maybe find some support at 16.5. So I also don't think this means we're out of the woods by any means yet either, just because today's firming up a tad.
What does out of the woods mean? Is this an opportunity to sell vol because we're going to have peace in our time with Greenland, or is this I don't apply technical analysis to anything, but definitely not VIX. And I'm just looking at the vol metrics in aggregate, and to me that's a more actionable signal. But insofar as is everything chill, yeah, kind of back to green and back to risk on from my perspective.
Okay, tell me about Friday. And then closing out the month, too, next week, when you watch expiries in the calendar, does that give you any insight on how to place your trades or which expiries to look at?
Yeah, if you look at the aggregate open interest and the gamma regimes that are kind of, we had VIX expiration this morning, we had S&P expiration on Friday, and then we had a 3-day weekend. So the idea that something big would happen because there's more freedom, options to move around, makes a lot of sense. And then also with the VIX coming off, effectively yesterday afternoon, this morning, I think that there is more chance for a wider dispersion of prices within the S&P 500. So I'm not surprised at all.
Yeah. Okay, so silver, you still kind of got some flyers on there to see if it pulls back more. But as you mentioned, kind of a hit it big or not, or just miss it trade, right? And I will say that silver has taken a bit of a hit today, so you've got a little bit of life left on that one.
Yeah, it's $82 right now in the SLV. We're long GLD, so it's not like I'm mad that metals continue to go up. I'm not long silver. I'm short deltas by being long some puts, but it's really not that big of a deal. Just when something has a multi-decade rip like that, it's difficult for me to not look at the downside in case we go right back. Now, could I have bought silver? Sure, of course, but I am long gold, and I'll consider that to be an adequate proxy for now.
Okay. I like that trade, by the way. I mentioned that when you brought it up, too, because of the silver's kind of nature as a higher beta cousin to gold, and gold working in so many regimes that I kind of like that sort of hedge trade. Long gold, short silver, take a stab at it. If one of them's going to break, probably silver. Like the eyes on VIX, too. Thank you, Noel. Appreciate you being on, man.
Thanks.
Good stuff. Noel Smith, Convex Asset Management. All right, markets are holding in. We did lose Bitcoin. It flipped to red there on the day, but not the worst thing in the world. We're still meandering for the cryptos, so we've certainly have seen worse in that regard. That being said, let's talk some of the other sectors that are working. I got Hans Albrecht joining us from Gamma Options Solutions. Hans, as we're talking about, it's kind of a shaky couple of days. Are you seeing any new trends develop? Anything that's presented as opportunity in some of this chop between yesterday and today's bounce back?
I think the opportunity, Oliver, is probably in the things that have been working lately, which is really different from what we've seen the last few years, right? It's this broadening theme. I know it's starting to, I remember somebody last year sort of said, Hans, you're a broken record. It's all about AI. But now the broken record might be this broadening theme, this move into, if I look at my turbo scanner, I can see these the strength is really in those industrials and some of the materials and some of those things. Even outside of the actual materials themselves, the companies that facilitate this build-out that we're seeing around the world, this is going to be some of the more dependable type stuff that I want to be looking at this year. Things like quanta services, for example.
Okay. Tell me about quanta, but actually when you were mentioning industrial, I was thinking about FCX, which you talked to us about a couple weeks back, right? And they've got earnings coming up. Part of that metals trade. Give me a quick thought on that one, because I feel like if you're looking for copper and gold and the metals to hold strong, this could be a fun flyer for earnings.
Yeah, and you get a little bit of a few different metals, right, when you play these things. And FCX, we talked about it, and it's had a really great run. And there just isn't going to be enough copper. So I call it my things you can drop on your toe theme. You can, things you can stub your toe on kind of stuff. And I think the world is kind of moving more towards that. There's a real need for these things that we just can't necessarily make more of or pull more of out of the ground very easily. And so we really shifted from a world that was kind of very focused on the sort of digital aspect of things, the hyperscalers, and it's moved into sort of this real world, which is very supported by a lot of the data out there that really shows that we've got this industrial resurgence going on, and it is something that's durable, right? So again, I often mention, people talk about, well, are these things cyclical? Is our memory chip cyclical? No, they're structural. And the build that we're seeing is a very durable growth trend. And so I can see this stuff continuing to go, especially because they've come from a very out of favor sort of outlook to something that's being rediscovered again.
Okay, I like that. And I liked Noel's trade too of being long gold, which has been really the rock, no pun intended. And then short silver is kind of the speculative a trade to look at the higher beta swinging version of this. But FCX, you kind of sprinkle that in there for an earnings flyer. Maybe you just bet on volatility, right? So you got direction for gold long, direction for silver short, and maybe you just bet on a big move, straddle or something like that, strangle into a long volatility position into Freeport. Do you hate it? What do you think?
No, I mean, look, it's had a good run, but I think what we've got to keep in mind is that we've gone from really out of favor in some areas of the broadening. And we've had some good rallies, but I think some of the balls in those areas are actually still enticing, right? Because we really haven't built in what I call that re-rating pricing, right? So the possibility that we are going to look at a growth duration, so meaning all that means is we're going to look at perhaps 1, 2, 3, 4 years of growth in some of these areas, and it's not being priced in. And I think that if you look around, that's happening in a bunch of areas. Look at how consumer staples have done. I reported to some of my clients a couple of weeks ago, I said, listen, consumer staples vol is cheap. I know it's boring. I know it's not the most exciting thing in the world. It's not NVIDIA. It's not all the crazy AI things. But it is cheap. So when you start to combine that outlook on vol compared to things that may have been forgotten, that becomes an enticing trade.
I like the XLP chart. I think it's a fun one. It has been really rocking for the last 2 weeks, but then it went sideways in the last 5 days. So a little consolidation, basically right at the 1-year highs. I'm putting a chart right now on the XLP. Basically 82 was an old level of resistance. So if we punch through there, you think this thing can rock and roll?
I think it can. I mean, this is sort of a fun little thing to watch, but I'm a little bit more interested in where the real growth is. So we talked about quanta earlier. So I'm starting to sort of frame things, or I'm continuing to frame things as there are going to be the disruptors and there are going to be the disrupted. And so we see people, for example, in the software sector, which you've been talking about, you look at something like Adobe, it's super, super cheap. Look at the valuation, look at the cash flow. Yeah, tell me what the cash flow is 3-4 years from now. The market is telling you it does not know, because there are going to be extreme winners and there are going to be extreme losers. And when there's uncertainty there, we don't really know how to value those things. So Google looks like it can do a whole bunch of stuff that 700 other companies used to be able to do. That's a really big important thing that I think we have to look into this year, is really understanding where the disrupted versus disruptors are.
Really good point. PWR for quanta, right?
Yeah, PWR. So think about
it's
this.
It's a good looking chart.
I don't want to own companies. Sorry, go ahead, Oliver.
It's a good looking chart.
It's a good looking chart, and I want you to think about it. It's kind of boring, but I think boring is beautiful suddenly a little bit again. So you take something like this, is really boots on the ground. It's people going out and maintaining and building out the grid, the electricity grid, very physical things that need to be done as this industrialization sort of plays out. And I don't want to own the utility companies that are charging people, because Trump's going to say, listen, you're charging too much. You can't do that. But guess what? These guys get paid because the industrial build out necessitates them to be involved. And that's how I'm kind of framing things. Who are the dependable, can't live without non-negotiable sorts of areas? And this is one of those names that I think is interesting there.
I like that point. You mentioned Alphabet, Google over Adobe. Great example of disruptor versus disrupted. The Adobe chart looks miserable, has for some time. I gotta say, my old show a year ago, I saw that one coming, same as you, that this was gonna be majorly disrupted. Even though I use, Premiere for video editing and graphics for the show, there's still a lot that I can do via other AIs. Graphics that I've made that you just plug into Midjourney or sometimes ChatGPT, but I use in my pocket and on the go all the time Google Gemini. And there's a reason why Kalshi says that's going to be number one AI by the end, well, it's the end of the year now, but that's their number one ranked, and the chart reflects it.
And that's, you nailed it on the head, Oliver, because that's the thing. It's not that Adobe is a bad company. It's not that they're going out of business. It's that we don't, in the ultimate age of disruption, which is what we're in, we will, over the next few years, we'll have never seen anything like it in the history of markets. There are going to be companies with moats that were this wide that are now this wide, even more narrow is what I'm trying to say, right? You thought they had this sort of massive moat, and they don't. And that's really the core of what we're seeing here in this world of everything being kind of re-rated, disrupted. And I think you cannot forget that. So valuation, not so important. Maybe you want to start looking at, well, how's the balance sheet look? Are they going to be able to battle it out for the next 3 or 4 years? And maybe this is cheap. Maybe it doubles because they figure it out. But we know that markets don't like uncertainty, and uncertainty is what is very much what some of these stocks are dealing with right now.
Your point that you made in our last conversation about the cloud companies that are really getting disrupted, I think you nailed that one, Hans. It's one also that I thought the writing was pretty clear on the wall really a year and a half ago as well, but it took a while to kick in. They went nowhere for most of last year. They never really recovered from the tariff sell-off, and now lately they're getting hammered again. So is this a way to hedge the market? Should we be short something like CLOU while we long PWR and long Alphabet and the other stuff, or is that too much leverage?
Well, I mean, it's a little bit of a sell-off. I do think there's a potential for a bounce here, but ultimately, I think that area is quite challenged. And I think that's part of what the broadening is about, right? The broadening is about this world that has done well for 2 or 3 years, which was fairly narrow. Think of the funnel that kind of opens. It's very narrow at the bottom. And now that world is challenged. There's competition, there's regulation, there's President Trump saying he doesn't like this or that. There's a lot of stuff that is now uncertain about that area. Very easy for investors to say, well, listen, is there no uncertainty, or is there little uncertainty? Well, it's going out into the world and saying industry A, B, and C, or company A, B, and C can now use AI to improve productivity. And that is, without question, some companies are going to harness that and make the most of it. So the market is really just shifting from what was a certainty to now questionable in some ways to areas which is the rest of the world where we think that AI is going to really, really make a difference, and it will.
Yeah. Well, a lot of those software companies seemed like they were ripe for some M&A, some combos. So I think AI is going to facilitate some of that. You've had good eyes on that trade. Love the stock specifics. Thank you, Hans.
Thanks, Oliver.
Good stuff. Hans Albrecht, CEO, Gamma Option Solutions. Let's do an ETF deep dive when we come back. If you're just catching on to the gold and silver mania the last couple months, you'll want to pay attention because my next guest was all over it when he kicked off his ETF, LENS. Wasif Latif, great macro mind, is joining me next year on Chicago Future of Finance 2-minute innovator buffer break, and we'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. All right, welcome back here to Cboe. I'm Oliver Rennick. We are cruising here at 2:37 p.m. Central Time. The S&P 500 at 69.15 represents a really nice bounce back. I want to take a quick look at the chart before we go into an ETF deep dive here in a moment, because this is a pretty good little recovery day here. Really key to see that we held some important lines. One of them was 6,800. Yesterday we put a line there on the futures chart when we talked to Joel Hawthorne, and boy, that worked out pretty well. Look at the size of today's candle, which is completely engulfing yesterday's, arguably a bullish engulfing candle. You do like to see that. Also yesterday, boy, I hope you're watching the show. I know you are because you're here. Tesla, we looked at support at 420. Bang, there's a nice little rip to 433. So a few things are working in the right direction. Of course, one of the most consistent ones has been gold. Today, fading down from the highs of 48.91 an ounce on futures, but still just an extraordinary chart. And over the past year, gold, the commodity, the yellow rocks, are up 74%. It's been a big part of the Lens strategy, the macro fund from Wasif Latif at Sarmaya Partners. An 80% run in the ETF, and that's a pretty incredible move since its debut about 1 year ago. Joining me here is Wasif Latif. And this is, by the way, let's not forget, special Cboe exchange traded profile, back in the groove. Wasif, great to have you on the show. Nice to see you again.
Thanks, Oliver. It's great to be here.
I've known you from my Bloomberg days as a macro guy. We used to talk markets, and you put your strategy into an ETF that just has been rocking and rolling. Give me the basics to start off here about what you guys have got in here.
So this is a strategy that we've had working for quite some time. We converted it and launched it as an ETF pretty much a year ago. So next week will be the 1-year anniversary, and it's been a great year for us. The gist of the strategy is this secular theme that we are calling the return to tangibles. And basically, as your previous guest was talking about, for the better part of the last 15 odd years, we've been in a world where everything was tied to digital investing and technology, and the idea that we are in a post-physical world, in the digital world, that's where the investors became complacent. Post the pandemic, all of the lockdowns and the supply chain constraints and the ensuing inflation because of the fiscal stimulus moved us into what we think is the new era, which is we're calling the return to tangibles, an era where tangible assets, i.e., stuff like commodities, like precious metals, gold, silver, platinum, and copper, are going to do really well. What we do in the strategies, instead of investing directly in the commodities, we do that only with gold and silver. Everything else we get through investing in equities. And because we invest in the companies, like, for example, the mining companies in gold or silver or platinum or copper, we're getting the operating leverage and the financial leverage of those companies, in addition to some of the base performance that you would in the metals, for example, in gold and silver.
There's kind of an irony here a little bit because there is the digital revolution, but then there is the importance of having the physical underpinning to it. And it sounds like you just think that those two things, which actually have a very natural pairing, people just got really lopsided in their understanding of it on the tech side, and now maybe this is like a catch-up trade to some extent.
And you know, we talked about before that in our view, markets operate in cycles, and there are short cycles, and then there are big secular cycles. So I think we've been in a big secular cycle where the zeitgeist became that the dirty, ugly, grimy commodities are a thing of the past, and we really don't need them in our digital world and this post world where everything is in the virtual space. And what we have come to realize over the past couple of years is the not only the importance of those grimy commodities, because our digital world is built on them, but in addition to that, one of a big sub theme as part of our portfolio is the that we are in an era of geopolitical and fiscal risks, and as a result of that, um, the escalation of geopolitical events and fiscal limitations becoming unsustainable are also part of the portfolio. So as a consequence of that, this is a catch-up trade, but it's more of a turn in the cycle in our view, and it's investing ultimately in stuff that's been largely overlooked, underinvested, underloved, and that includes energy as well, which is a decent part of the portfolio, such as oil and gas companies, which we think are poised for the next leg up in this space. But to answer your question, yes, it is all about a resurgence or a reversion to this secular theme that is tied to commodities.
Okay. Now, one thing that I wonder in here, kind of always a question from the trading mindset, but not always a question from the ETF mindset, where a lot of people kind of take a set it and forget it approach, or that's kind of how they associate things. I wonder how active you have to be. I know that we're looking at the description of what you do, active managed equity, and we're talking about some of these sub themes, but looking at the holdings of the ETF in some more detail here, big portion in gold, obviously about 9%, SLV 6.7%. How do you know when to close those trades out, Wasif, or are they sort of permanent parts of the portfolio?
Yeah, that's a great question, Oliver. No, we're very active in our strategy, and the active management is on multiple layers. So one layer is looking at the sub themes within the broader return to tangible theme. So the sub themes are that we are in an era of geopolitical and fiscal risk, which is where gold and silver miners reside. And then the other sub theme is that energy is life, and that's where all of the oil and gas companies reside and uranium companies reside. And then the third sub theme is that we're going to build the future, which is where the platinum, the copper, the industrial companies, the shipping companies, they lie. And what we do is we actively adjust the weights across those sub themes. But in addition to that, we're also actively adjusting the weights within those exposures to the different companies. So it is bottom up stock selection as well. And then the last piece is it is all about relative attractiveness and relative value. So, for example, a few years ago, when this strategy was not in an ETF form, it was run separately, we had a lot higher allocation to energy and energy companies in the portfolio. And about a year ago, year and a half ago, we significantly began to increase the exposure to gold and silver companies and the metals themselves, given what we saw based on the macro environment, but also on a relative attractiveness basis as well. So it's a combination of relative value and seeing how things are run. And when things are run a lot, then something that hasn't run as much might look a little bit more attractive, and we'll look to adjust. But we do know that once these secular themes begin in earnest, they go on for many, many years, hence the name secular. And so one of our flagship charts that is in the presentation that I sent to you,
I got it for
which
you
is
right
about,
now.
oh, awesome, which is about how once a secular theme begins, it goes on for quite some time. So when you look back in history, every major market cycle has had some kind of a secular theme that's dominated that market. And we've had gold and oil in the 70s, Japan in the 80s, and then all the way to the right is this nascent secular theme that we think has begun, and it's got many, many years ahead of it, which
Boy.
is what we're calling the return to tangibles, which is the foundation of our strategy.
Okay, I actually clicked off it. Then we click back to it because that gets me excited, Wasif, because you got a lot of charts that look like they went kind of parabolic, or at least were
Right.
very rewarding. Is there a way to translate what that might mean for the price of gold? Not to try and play pin the tail on the donkey, but
Sure.
What price is reasonable here with the commodity per ounce trading at $4,800 right now?
Yeah, we actually have a price chart. I don't know if you can get there. It's looking at the prior two gold bull markets,
Okay.
and how much they returned in the 70s and then in the 2000s, and comparing that against the current bull market. A lot of other folks have built similar charts as well, and it's just trying to put the current bull market in context and perspective. And when you look at that chart, two things stand out. Number one, early innings in terms of the time frame, the length of time of those bull markets. And then the second thing is the amount of return is still somewhere in the middle of what the returns were for those two bull markets. And when I think about the bull market today, or just the broader tangibles market in this environment, to us, it seems like we're in a world that's a combination of the 1970s and the 2000s, where you have a lot of fiscal dominance and government spending, like it was in the guns and butter era of the late 60s that led to the inflationary era. There is the possibility of some type of a monetary reset, although that's not baked into the strategy that it needs to be happening to do well. And then the last piece is the 2000s comparison is similar to that the rest of the world continues to grow, that global GDP will continue to be well, and the demand for the industrial usage of these type of things, including silver, but also the broader investment for gold, i.e. this time around coming from central banks, will continue to be this pressure. So all of that is to say, in our view, it's still early innings, and we think we're going to end up from a return standpoint somewhere in between what we saw in the 70s and what we saw in the 2000s with respect to gold.
Boy, that's very cool. I have to say it's a very unique macro take, Wasif, because what I hear a lot of is people are having to be very polarized in their assessment of why what's happening is happening. You hear a lot of people struggle when they try to merge their bullish gold view, which is often based in ideas of political upheaval and debasement of currencies and things that sound a little bit more on the apocalyptic side of the agenda, as opposed to what you're saying, which is that you can have a real kind of cyclical demand for these things. Maybe you get a little of that draw from that crowd that is buying them for those reasons, maybe replace bonds in their portfolio, but that they're actually hand in hand connected with tech. Because what I hear a lot of people say is they'll go, okay, well, this is all happening, gold's going up because the system's breaking down, right? It's kind of the same argument you hear from the coiners. Obviously, Bitcoin didn't work very well yesterday. But where it breaks down is then I go, okay, well, then how come the benchmark for capitalism, the US equity market is doing so well. And they have to go, oh, well, if you price it in gold, it's not. And they get through all these kind of messy explanations. Your explanation to me makes a lot more sense because it says there is demand for physical commodities for good reason. As you describe it, energy is life. Maybe there is some geopolitical and fiscal risk, but there's also a real tech side to that too that can live in harmony where you have tech revolution happening and the demand for these things that doesn't have to require some like negative upheaval of the system. Does that make sense?
It absolutely does. And it ties back to a phrase that we've been using where we think that if you look at and we have a chart on this, when you look at the grid of economic growth and inflation, we believe that we are squarely in the quadrant that is inflationary. Now, that doesn't necessarily mean it's all bad and apocalyptic. What it means is that the current government, not just in the US, but also now Europe, I think, is also trying to do this, which is create a run-it-hot economy. And in a run-it-hot economy, when you have high levels of debt that on paper and projecting out seem unsustainable, the way to manage those is to inflate your way out of the problem. So if you have deficits or debt that you need to manage, if you let the economy run hot with a higher level of inflation, just a tad bit higher, then over time you can inflate your way out. When that happens, what happens is a gradual loss of the purchasing power of the currency and inflationary pressures, which is good for haven assets like gold, for example. Our base case is we're going to get an inflationary world either way. The current government is trying to do a run-it-hot economy. The risk is that they end up getting a stagflationary environment of the 1970s. If that happens, the stuff that we own does excellent. If it doesn't happen, if it's still a run-it-hot environment, then the stuff that we own still does well because it's going to continually move higher based on this underlying inflationary pressure, but also an actual economic demand that's coming in from these fundamental pieces. For example, silver, it's not just the precious metal side, it's the actual physical demand for silver. There's an actual shortage. There's a projected shortage for copper, given how long it takes to get it out of the ground. It takes about approximately 18 years from discovery to production.
Wow.
So the demand and supply is going to be a really driving factor there as well.
Well, I think the run it hot, if we have a little bit of inflation, and by the way, it's come down substantially too. You know, people were really worried it was never going to come down from COVID. I know that a lot of people would like to see inflation further away from 4%, but hey, you know, if we're running it hot, that's a pretty good outcome that could work for tech and the commodities. But right now, a commodities heavy focus that has been working very well for LE&S. Wasif, great stuff. Thanks for being on the show. Really interesting explanation. Great charts. More to dive in there, so I'm sure it won't be our last chat, but we'll be in touch. Thanks a lot, sir.
Thank you.
You got it. Wasif Latif, what an interesting approach and an interesting macro view. Very nuanced. We got some trades to close it out. When we come back, there's a hurricane trade in the mix with Chris Brecher. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, might be a winter ice storm coming across the U.S. Chris Brecher joins me from Trading Nest TV back to back with some interesting trades. I've been liking your stock specifics. You got good eyes on the market, Chris. All right, so look, no surprise, it's freezing cold here in Chi-Town. It has been for a minute, but I guess it might be about to get worse in more places. I'm just pulling up the news flow right now. Southern U.S., the place that's supposed to be free of this nonsense. What's going on?
Well, I look at, I'm a real weather nut, so we're actually signing up again for Weather Spotters here.
And, nice, okay, a little shout out for software there.
Yeah, well, this all started my first year in Chicago when I was a clerk. So everybody said however it goes on New Year's Eve, and all that is how your year will go. So the first year I went to one of the jazz bars there and met somebody, and they gave me their phone number, and it ended up being the weather service. So
nice. Well, when you're in
you
Chicago, it becomes real important to figure out just how screwed you're going to be this time of year.
Yeah. Do you know the back room on Rush Street?
The bar?
Yeah.
Familiar.
Yeah, that was one of my favorite places when I used to live there. But getting back to it, on YouTube, I look a lot at this person, Ryan Hall Y'all. He's a meteorologist. He's really good. There's also Mr. Weatherman, a number of these. And if you look, it's going to scare the heck out of you if you live in the South. They're talking about an inch of ice in Atlanta. And they're talking about in New York, 17 inches of snow, and they're talking about in the Appalachians and the Smokies and Asheville, at least an inch of ice, which is pretty, well, they're using the words the same as a hurricane, actually worse.
He says one day ago, it just took a bad turn. He says this will be a memorable storm. Ryan Hall, y'all. Apparently this is the guy, 3 million subs on weather.
Yeah, he's pretty impressive, and he does storm chasing and all that, which I want to do. My wife won't let me. But basically, I watch that like a hawk, and I grew up in Florida, so we used it a lot for the watching hurricanes and all that stuff, living on the east coast of Florida, and also growing up in Florida. So definitely I watch this really carefully. And now they're saying this could be as bad as a hurricane damage-wise. So that's why I got on our site and Discord site early to go over this, and that's why I text you that I'm happy to go over how we're looking at strategy for this.
Yeah, tell me about it. I'm looking at Kalshi right now. I just pulled it up to see if there's any interesting bets for the Southeast. I'm not seeing much. They've got one bet in Miami, highest temperature 71 or below 80%. So, I mean, I guess the bar there is still pretty high. Is it like the power, the generator trades and stuff? What in the stock market could work for this?
Well, number one, I'm actually sitting and after the close checking our oil and all that in our Generac generator. So we have a lot of animals, and so they're first priority.
GNRC.
And, so that's number one. And just so you know, I mentioned earlier in December that one of my crazy trades for 2026. I mentioned the Cuba trade, and I mentioned about Generac getting taken over.
I still got the line on the chart here, and it looks like we're trying to punch through it and move even higher.
Yeah, is what happened. I'm trying to compare it. I mean, there were no hurricanes last year. In fact, Home Depot on their earnings report actually said one reason earnings were lower than expected was because of the lack of hurricanes. By the way, I'm going to try to change my camera. Tell me if this is better.
Yeah, you get a little flash there, but You're all right.
Yeah, I saw it flashing like that.
There you go.
Is that better?
We got the little prairie dog version of you.
Yeah. Sorry about that.
All good.
I'm still working with this camera. But getting back to it, though, in 2024, in September 27th, when it nailed Asheville, Home Depot, Generac, Lowe's, they went up continuously into the event. And for like a week later, which makes sense as you assess the damage, people need building supplies. So they actually went up till about October 10th. So I don't know if you could go to on demand and go to October 16th, 2024. That's what we were doing.
Okay.
So we were going, you could look at a weekly. It works also. That works fine. And you'll see that it rallied into the event, and about 2 weeks later, it started settling down.
Okay. So
that's-
GNRC, potential trades?
And Lowe's. And then
Lowe's.
I got one on the downside. So a lot of people talk about, well, if there's no power, you're going to go to Darden or you're going to go to Olive Garden. But if there's ice, you ain't going anywhere. So if you look, one of the worst acting stocks today is Darden.
Right, it is. It's getting hit down. Not a good week, by the way.
Right.
Yesterday
Well, they've
and
probably
today.
been anticipating. But look at this. I mean, it didn't really bounce today. So we're actually looking at a short idea, Darden, into the next week. We're looking at there's actually 4. There's Generac, Lowe's, Home Depot, and then the one I told you that I liked as a Cubitrade anyway is Fluor.
FLR. Yeah. Mm-hmm.
And as you see, I think the chart looks pretty good.
Yeah. I think of all the charts, I like the consolidation for Fluor to maybe rip here. Pretty good day today, up 4.25% for sure. But actually the one that really stood out to me is Lowe's. You got this massive candle today that engulfs yesterday's downside, puts you right back at the recent highs, and at 52-week highs, it looks like we just found support at the 52-week high, which is always a pretty bullish indicator in my mind, usually a pretty bullish indicator.
Yeah, if you would have looked last year, would you have thought that Home Depot's 40 points from a new high and Lowe's is at a new high? I mean, forever we've heard about Home Depot's been eating Lowe's lunch. So I'm looking at Home Depot more because it's been such a laggard. Yeah. So I like that 380 level right there.
Little catch-up trade, Home Depot at 380. I like it. Lowe's maybe for extension. And then Generac too, I think works pretty well if you think there's a big ice storm coming. And maybe short Darden. We got to jump, Chris. I like it though. Good picks.
Yeah, sure. Thanks again for having me on. Still working on the camera, so
that's all right. It's okay. It's more. The stocks are more important. I like the eyes on the market, creative ideas. Thank you, sir.
All right. Take care.
Appreciate it, Chris Brecher, TradingNest.tv. All right, bell rang. Stocks had a nice bounce back today. The S&P 500 did slip a little into the close, but that just leaves us a small wick on an otherwise green candle. Thanks for tuning in. I'll see you tomorrow, 2 p.m. Central Time.